China has become a worldwide economic behemoth in the past 2 decades. In terms of economic growth, China has surpassed all other countries. But what if this whole Chinese economic growth has all been a huge lie? Cathie Wood, CEO of ARK Invest, believes this is similar to Japan's economic calamity 30 years ago. Just as a property boom boosted Japan's GDP, China is expecting a historic housing bubble of its own. This video will show you how the world is about to wake up to China's imminent economic disaster. But before we begin, make sure to keep yourself informed and engaged by subscribing to the channel and clicking the notification bell so you won't miss out on our latest uploads. The Chinese economy has grown significantly in the recent 2 decades, primarily because of real estate. Landlords have taken out loans to increase their property portfolios around the country. Cities in China are full of glass and steel apartments, offices, and houses. Speculators began purchasing homes merely to increase their value. After all, Chinese property prices have been consistently increasing for decades. Some cited China's rapid population growth, but the suspicion ran much further. Property prices in cities like Beijing and Shanghai continue to grow year after year, making traditional housing unaffordable for most Chinese. Buying a residence close to cities but far enough away to prevent ridiculously high prices became the norm, and many citizens did just that. People began moving to suburbs 10 or 15 miles away from Chinese cities. Due to rising demand, prices for homes near cities have increased, causing residents to migrate further away. Property developers anticipated further expansion and built residences further out ahead of time. Now, if you drive an hour or two outside of Beijing or Shanghai these days, you'll notice something weird. There are several modern buildings in great condition, yet no one seems to be there. These quote-unquote ghost cities exist solely because speculators believe that property values will rise. This shows China's increasing real estate bubble despite the industry being a major economic driver. I want you to take a look at China's most famous ghost town, Ordo's New Town. This city's population was planned to be 1 million individuals, but it fell to 300,000 in 2015 and subsequently to 100,000 in 2016. Ordo's empty dwellings only filled up after bringing elite schools in. These types of vacant units are so common that the total amount of room available could fill the whole country of Italy. After 20 years of growth, the Chinese real estate market is now worth over $50 trillion, about double of that of the United States and nearly 4 times the Chinese GDP. According to Loomis Sales, a wealth management firm, 70% of Chinese wealth is in real estate. In China, residents often save for decades just to buy a single house. Property prices near cities are so expensive in relation to residents' income that inhabitants will need to borrow money to buy a home, even after saving for years. Rising property prices create a fear of missing out, leading to dangerously high debt levels. Fun fact, 4 of the 10 most expensive cities to buy a property are in China. This appreciation is alarming even if it won't last. We observed similar symptoms during the 2008 recession in America, and now we see them in China. The Chinese real estate bubble is already showing signs of collapsing. Because the Chinese house market continues to climb in price, developers have done all possible to expand their real estate holdings. Unfortunately, greed took over, as it often does before a financial disaster, and developers were soon in over their heads in debt. One of these developers was Evergrande, the Chinese real estate giant. Evergrande is one of the world's largest real estate developers. Evergrande increased its real estate holdings to approximately 565 million square meters by issuing corporate bonds to overseas investors. However, Evergrande could only do so by borrowing $300 billion. Evergrande flourished due to its tremendous cash flow. Because of this, Evergrande became the world's most valued real estate firm in 2018. As investors realized Evergrande's major issues, the bullish sentiment quickly shifted. Evergrande recently fell into debt after failing to pay a $260 million interest payment. As a result, Evergrande's bond prices have plummeted in recent months, producing a credit crisis. International bondholders have threatened to sue Evergrande over its financial issues in reaction to this. Not to mention, President Xi Jinping's crackdown on the Chinese real estate industry is also a significant part of this problem. President Xi's effort to reduce China's reliance on real estate by restricting speculation. Xi says homes are for living, not believing. Because of this, President Xi's actions endanger China's economic stability. Even though Evergrande is considered one of the biggest companies in the industry, it's just one of several developers defaulting. China's property developers are currently dropping like flies. Shimao, a Chinese developer, recently failed to pay an interest payment of $101 million. Another developer, Oceanwide Holdings, defaulted on a $175 million loan. According to a recent trade, 484 companies were 3 commercial payments late in the fourth quarter of 2021. This is a mind-boggling sum, but the issue is only getting worse as time goes on. Chinese real estate is clearly not the best investment right now, and developers are well aware of this. Contract sales for the largest real estate development companies fell 35% in December 2021. Furthermore, Cathie Wood says this is the first year in over 20 that development enterprises have witnessed revenue decline. Even the Federal Reserve has noticed China's real estate bubble, fearing a collapse in the Chinese market could affect the U.S. economy. Stresses in China's real estate sector might affect the financial system, with potential spillovers to the United States, the Fed noted. The Fed highlighted China's government and municipal debt to support this claim. As of now, in many economists' eyes, China's high GDP growth signifies economic success. However, a vast debt bubble throughout China's economy, not just in the real estate, drove much of that rise. Debt per capita in China has risen dramatically in the last 2 decades. China's GDP is increasing rapidly, but so is its debt. Due to the severity of the debt crisis, China's total debt as a percentage of GDP is nearing developed countries. Imagine a country like China, with the same debt to GDP ratio as Switzerland, Hong Kong, or Germany. This kind of overextending oneself is bound to fall. On real estate, the Fed emphasized excessive prices and how China's Communist Party's crackdowns may cause them to collapse. This was in reference to the Chinese government's 3 red lines real estate strategy. The 3 red lines indicated the borrowing restrictions for real estate developers: less than 70% liability to asset ratio, less than 100% net debt to equity ratio, and 1 cash to short-term debt ratio. Companies that meet these criteria can increase their debt levels by 5% annually for each red line. It is fair to create such a policy, but the government should have done this many years ago. As a result of their new regulations, Cathie Wood equates the CCP's actions to playing with fire. Overextended developers will be difficult to rehabilitate. The issue with these 3 lines is that property developers cannot simply avoid their responsibilities. The only option to stay inside the limits is to sell houses, which is exactly what many developers are doing right now. Evergrande and Cathie Group Holdings are rushing to sell their homes. As of today, the Evergrande Tower, home to Evergrande's headquarters in Hong Kong, is being put up for sale. However, that property is still yet to be sold. On the other hand, Cathie has 18 projects for sale, totaling 4.7 million square feet. Like Evergrande, Cathie has yet to sell these projects. The issue with all these for sale homes is that no one wants to buy them. All other real estate developers strive to meet the 3 red lines. If no one wants to buy it all, Evergrande and Cathie will have to lower their prices. However, if these prices keep falling, the market will collapse. Evergrande demonstrated this by proposing a 30% discount on all houses to raise revenue. Yet, a 30% price decrease isn't enough to attract customers. Evergrande's properties aren't selling fast enough to cover the company's loan interest. This would stifle China's traditionally rapid GDP growth, one that experts have long praised. Property development dominates China's economic output, accounting for 29% of overall GDP. Imagine the economic impact if this industry falls. The Federal Reserve says China's impending downturn will harm everyone, not just the Chinese. The Fed warns that China's economic slowdown may strain global financial markets through worsening of risk settlement, pose challenges to global economic growth, and have an impact on the United States. In other words, a collapse of the Chinese real estate market would hurt the global economy. China produces nearly all of the world's goods. In 2019, China accounted for roughly 28% of global industrial output. You may think China is too big to fail, but this isn't the first time we've seen a major economic downturn. In many ways, the 1989 Japanese real estate crisis is identical to the current situation in China. In the 1980s, Japan was the gold standard for emerging markets. As one of the world's most powerful nations of the time, economists expected Japan would eventually surpass America. According to news reports, Japan's theoretical land value was 4 times that of the US. Other countries sought Japan's 3.89% annual real GDP growth rate in the 1980s. However, after decades of economic prosperity, Japan was deeply in debt. Like China's, Japan's corporations borrowed heavily when the finance ministry encouraged them to do so. A low interest rate policy, deregulation, and domestic stimulus increased the money supply by 8 to 10% annually. Prices, like Japan's GDP, rose steadily. Japan moved quickly in the ranks, but its economy sank even faster. By 1992, the Japanese stock market has dropped 60% to 15,900. The Nikkei index plummeted another 45% over the next 2 decades on top of the prior 60% drop. The quote-unquote lost decades refer to the long period when equity prices did not rebound. Cathie Wood says China is in a similar situation. Increasing debt has driven Chinese property value to new highs. China's impending demise will cause colossal deflation. A looming crash might have far-reaching effects. The prices of commodities hasn't fallen substantially yet. However, consumer confidence is still high, which may be misled by food costs. As I record this video, property values are already sinking. New home prices dipped 0.3% month-on-month in China in November, while sales fell nearly 16% year-on-year. A 0.3% monthly drop may not seem like much, but that becomes a 3.6% annual drop, which is quite scary. What's worse is that housing prices in China have slowed to levels not seen since 2015. Cathie Wood further noted in her quarterly report that she expected China's GDP to fall sharply in the next 3 to 6 months. Quote, "If we are accurate, the market is likely to focus more on the likelihood of a recession in the US, the significant downturn in the Chinese and emerging market economies, and perhaps an unexpected decline in inflation over the next 3 to 6 months," end quote, Cathie added. Some commodity prices have already started to deteriorate. The Baltic Freight Dry Index has declined more than 40%. DRAM prices have fallen 25%, and the US lumber prices have fallen 33%. Even the WTI oil price dropped by 12%. The Chinese Communist Party has acknowledged that the Chinese economy is failing, but has prevented a collapse. The Chinese central bank has announced a rate cut to support the economy. This contrasts with Fed Chairman Jerome Powell's aim to raise rates gradually. To sum things up, China's real estate industry is in serious trouble and will only get worse. S&P anticipates a 10% reduction in national home sales in 2022 due to a credit tightening and restrictive policies. Regardless of where you are from, this economic decline will affect you. And with that, we conclude the video. Please post your views about China in the comments section down below. Do you agree with Cathie Wood? Please give this video a thumbs up if you like it and subscribe if you appreciate it. In the meantime, I'll see you in the next one.